we get close to the town, you can hide in the cart with the sake.
The Mongols won't search it?
Not anymore. It's the same sake delivery I always sell them. They love my dars. Dars, Uncle, give a dars now!
You've been doing business with the enemy.
I keep the Mongols drunk, and they let me keep my head. Oh, Seth, you sure you want to go through with this? Anything for Taka.
How bad is the occupation in Azuma Bay?
A few people fought back. The ones left alive are prisoners, slaves. But you never saw Taka? No. But someone's been working the forge the past few days. Maybe it's your brother.
How long have you two known each other?
Since I was too young to know better. I was just starting to brew sake. So, do you know my first batch? It tasted like piss, but it was cheap. For a while, I tried to get Taka's help selling it. Turned out he was too soft. People told him sob stories, and he'd give them sake, free of charge.
It is in the form of notes or coins, and it is not backed by any commodity. That means if government wants to produce paper money, it doesn't have to be backed by gold or silver coin.
Mongols.
In India, the coin and one
You two better get in the car.
There aren't many. I can handle it.
No, Jin. Taka is so close.
And for notes above 1
Please.
RBI Act of 1924 gives the RBI the power to produce this. Now, we also hear about the term legal tender. So, most of the time, fiat money is equal to legal tender. Any fiat money is said to be legal tender only when it is backed by law and government, and it cannot be denied. That means if I want to purchase something, or if I want to repay some debt, in that case, if I give you a 500 rupees note, which is a legal tender, and it is backed by government, you cannot deny that. That means legal tender is nothing but fiat money, which is backed by law or government, and which cannot be denied. If I want to give you an example, here I have a bank check and here I have a 500 rupees note. Out of this, 500 rupees note is considered to be legal tender as well as fiat money. Bank check is not fiat money as well, because bank check is an intention to give money, doesn't guarantee anything. Whereas 500 rupees note, it is also in a promise note. Here you can see, here RBI government has written that I promise to pay the bearer the sum of 500 rupees.
You said they don't do
that. Is also called as promise note. Now, moving ahead, and let's understand the basic difference between fiat money and legal tender. You know, this happened around November 2000.
You, stop!
We had 500 and 1,000 rupees notes.
Das for Azuma Bay!
But the legal tender or the government backing was used in around 2016. Therefore, this money is said to be fiat money, but now they are not legal tender. So I hope you have understood the basic difference between fiat money and legal
Your
tender.
brother's a skilled blacksmith.
Barter
They
system
won't
to
treat him
commodity
like
money,
that.
and from commodity to metallic money, and today we are using paper money. Moving ahead, today is the world of digital currency. What digital currency means is, so digital currency is a form of currency that is available only in digital or electronic. Today, if we have stored in our bank account and which we use through Google Pay and PhonePe, that is not digital currency because it is also available in physical form. Digital currency is only available in digital or electronic. Here I have mentioned that till date, 10 different countries have launched their central bank digital currency, and the first country to launch it was Bharat. So we have to remember this to the entity point of view. The Google Pay PhonePe which we use is not digital because the currency, if it is available in physical form, is not called as digital currency. Now, we will understand what is the difference between cryptocurrency and digital currency. Cryptocurrency, if I give you some examples, you know Bitcoin, we have heard of Bitcoin, Dash1, Ripple, Ethereum, Litecoin. So all these are cryptocurrency. So what is the basic difference between cryptocurrency and digital currency? I am highlighted in the form of table. So cryptocurrency is also store of value that is secured by encryption, and whereas in digital currency it is electronic.
This is where we part
Fiat
ways.
money that can be used
Keep the Mongols drunk and distracted.
transaction.
I'll do my best.
Now,
Stay safe,
basic
Genji.
difference is it is
And
decentralized
you,
and
Lord
unregulated,
Sakai.
whereas digital currency is centralized and regulated.
Taka's waiting for us.
RBI is the only
Let's go.
central agency which can regulate the
Once we're
currency,
done,
therefore it is
I'll meet you at the
centralized, whereas
crossroads
cryptocurrency
behind
is
town.
also it is not regulated. In case of digital currency, it is regulated by RBI. Now, another difference is cryptocurrencies are highly volatile. You can see the differences in rates of cryptocurrencies. Whereas digital currency are mostly stable like our normal currencies that we are having. Cryptocurrency transactions are publicly available, whereas digital currency transactions are available only to the sender receiver and the bank.
We need a vantage point to scout ahead. Remember, no alarms. Keep this quiet.
The basic difference between cryptocurrency and digital currency is the concept of blockchain. The cryptocurrencies are based on the concept of blockchain, and they were introduced to execute this concept. Let's understand blockchain with a simple example of banking system. Where the person wants to send some money to person, and to do so, it has to take help of an intermediary, which we know today in bank. So what will bank do? It will take money from person one, keep a record that it has received the money from person one, then send send this money to person Q and keep a record of it. This is the function of bank here. Now, if I want to reduce the dependency on this bank, this is the central power. What I have done is I have
We need a
created
vantage point to
perform
scout
the
ahead.
same function as bank.
Remember,
Does it
no alarms. This quietly.
In this case, what will happen is, let's say the transaction is going to happen between person 1 and 2. A person 1 sends money to person 2. The
Once
record
we're
of the
done,
transaction
I'll need
is
to have
not
the
stored only
crossover
in one
behind
system,
town.
but stored in multiple systems. And these record systems stored in multiple systems is done through the technology of blockchain. It is nothing but decentralized ledger where the record or transaction is kept with multiple servers and dependency on single system is avoided. This system or this technology is nothing but blockchain technology. Here are 2 points which will help us to understand the blockchain more easily. Here you can see the bank work is done by different servers or computers in the system. Verification of the transaction is done by all the servers, and these transactions or this verification is incentivized by the virtual currency known as cryptocurrency. So you might have understood how the birth of cryptocurrency happened, because in order to incentivize this individual server, they had to be given some currency, and that currency is nothing but virtual currency or cryptocurrency. So they are incentivized to perform this verification, and they are given the incentives in the form of currency. Here we used to give banks some bank fees, transaction fees. Similarly, the servers here are given the fees in the form of cryptocurrency. Why new currency was developed? Because they wanted everything to be independent. If they had taken the original currencies like rupees or dollar, then again the control of central bank would have come. But in this case, the decentralized system wanted a decentralized currency, that was cryptocurrency, which is not controlled by any one person. Moving on, third point, different blocks are created for information to be stored, and it cannot be altered unless everybody agrees, therefore it is decentralized. So here in this case, if the bank, if it wants to alter the information, it does not require the permission of any other person. But in case of blockchain, it is not possible. That is mentioned in this third one. So I hope you have understood the concept of blockchain in this banking transaction example. Now, if you go back to these images, so you can see the information is stored in the form of the ledgers are created. These are distributed among different servers. Transaction is recorded. It is confirmed by all the servers, and for this proof of work, they are incentivized, and the result is nothing but blockchain. I hope you have understood the concept of blockchain and the virtual currencies, how this is different from digital currency as well. So if you want to know in detail more about the blockchain and its functions like NFT and cryptocurrencies, here is the link which you should go through. We have explained the concept in very simple method, and that you will get to understand that in future how digital art will become more valuable. So I hope that you have understood the concept of blockchain, also the cryptocurrency and digital currency difference. Now, this was developed by NPCI, which is very important organization which we should know about. They have developed many different payment related tools which we use today, and many of you will be surprised that NPCI is nothing but an initiative by RBI and Indian Bank Association. So you have to remember this, and it was introduced in 2008 under the provisions of Payment and Settlement Systems Act. It has initiatives like RuPay card. In the next slide, I have mentioned here in the image form as well. Many of you have used the RuPay card, or at least you have used BHIM app or the UPI, which has rocked the world. That is Unified Payment Interface. It is the digital transaction tool which every bank is using today. So you must be aware about this agency, that is NPCI. So NPCI is an important agency which is formed in order to promote financial inclusion. Along with that, it also helps in operating retail payment and settlement systems and developing it. The important initiatives under the NPCI were the RuPay card introduction, then BHIM, that is Bharat Interface Money, and the most important one was Unified Payment Interface, that is UPI. Moving ahead, now after understanding the function of money and the history of money and how we have evolved from barter system to the cryptocurrency, let's understand how this money is playing an important role in our economy and how the supply of money can affect the inflation and also change the growth of the economy. First of all, starting with the basic, what is the need for money? For individual, it is used for consumption, or the companies use it for investment, or government needs it for expenditure. So how do we raise this money? If we see for individual, they have 2 options. Either they can go through the bank and take the money for long-term or short-term purpose, or they can go for non-banking institutions like friends and families or private lenders. These private lenders are also called as informal financial intermediaries. So we need to understand what this informal means. Any institution which is not regulated by any government body or any other organization is said to be informal. And what is financial intermediary? Any institution which facilitates the financial transaction is said to be financial intermediary. So we have understood, if the individual, if he wants to raise the money, either it can go to a bank or non-bank in the form of friends or private lender. If a company wants to raise money, it also has 2 options, that is bank and market. Bank is regulated by RBI, whereas market is nothing but equity market, bond market, debenture. So I'll explain in brief what is equity and bond here, and in further lectures we'll get into the depth. Equity is nothing but percentage ownership. So if a company wants to raise money, so what will happen is, if you go to some person and ask for money, it will ask for something in return. And in return, if you give the ownership of your company, we can say that it is equity type of raising money. And if you give some assurity to the person who is giving money in the form of interest, is nothing but bonds and debentures, and the money raised will be in the form of bonds and debentures. We have studied about bonds in the previous lecture as well, where we studied about government security and how we understood that bond is nothing but a paper where the name of issuer is there, the percentage of a return is guaranteed, the face value is there, the tenure is there. So this bond is nothing but an assurity to the person who is giving money to this company about the return on his investment. Let's discuss few more things on the same slide. Firstly, about the equity, we have talked about primary and secondary market. This is nothing but the trading which we do in the stock market. So हम जो शेयर खरीदते हैं और बेचते हैं उसे हम सेकेंडरी मार्केट कहते हैं, और द फर्स्ट टाइम जब कंपनी शेयर अलॉट करती है वो प्राइमरी मार्केट में होता है. एग्जांपल है आईपीओ. और ये दोनों ही मार्केट को हम क्या कहेंगे, कैपिटल मार्केट. कैपिटल मार्केट यानी फॉर लॉन्गर पीरियड व्हेनेवर वी ट्राई टू रेज फंड वी से इट इज डन इन कैपिटल मार्केट. शॉर्ट टर्म के लिए अगर करना है तो वी से इट इज मनी मार्केट. दैट कैन बी डन थ्रू हाउ बॉन्ड्स एंड डिबेंचर. अब डिफरेंस है, व्हाट इज द डिफरेंस बिटवीन बॉन्ड्स एंड डिबेंचर? बोथ आर नथिंग बट डेट इंस्ट्रूमेंट जिससे हम लोन लेते हैं. डिफरेंस इतना ही है कि बॉन्ड्स आर बैक्ड बाय सम फिजिकल एसेट और डिबेंचर्स को कोई बैकिंग नहीं रहती. बॉन्ड्स कौन इशू करता है? गवर्नमेंट कर सकती है, प्राइवेट कंपनीज करती है. डिबेंचर्स आर मोस्टली इशूड बाय प्राइवेट कंपनीज. रिस्क इसमें ज्यादा है डिबेंचर्स में. क्यों? इसको कोई फिजिकल एसेट की बैकिंग नहीं है, तो डूबने का चांस ज्यादा है. इसलिए हाउ यू विल रिमेंबर, डिबेंचर्स डूबने का चांस ज्यादा है. दे आर नॉट बैक्ड बाय फिजिकल एसेट, देयरफॉर दे आर कॉल्ड एज डिबेंचर्स, एंड इंटरेस्ट रेट ऑन डिबेंचर्स इज हायर कंपेयर्ड टू बॉन्ड्स. So I hope you have understood the basic difference between bonds and debentures. Those are nothing but the financial instruments which are used to raise money in the market, and when these are raised for short term, we call that to be a money market. This equity market is controlled by SEBI, and both these equities and bond debentures are called as securities. Reason being, securities are those financial instruments which can be traded publicly. So therefore, they are called to be securities. Now, there are other types of bonds and debentures. For example, convertible debenture. It is nothing but mix of equity and bond. For example, let's say you have a debenture, and on this debenture there is a condition that at maturity you will have an option either to take percentage of interest or you have to convert this percentage of interest into the equity, that is the stock of that company. So whenever you have such options of conversion, that type of debentures is nothing but convertible debenture. The interest rate of this convertible debenture is also less compared to the non-convertible debenture. Now we have understood that how companies or individuals can raise money, and we are here to understand that how money supply in the market or in the economy will affect the inflation and GDP growth. So therefore we were studying about how the money can be raised, and now we will understand the basic concept of money supply, which we have regularly used in our lecture. But let's understand what money supply is and how money supply can affect an inflation. I will give you a simple example here. So if you can see how money supply and inflation is related. Let's say there is bank and which is giving loan at very cheap interest rate. Therefore, I'll call that money as cheap money. And individuals like us will be incentivized to take loan. And in that case, what will happen is the money in the market or economy will increase. That is nothing but increase in money supply. After that, what happens is when we have more money, what we try to do is purchase more and more things. That is demand for product and services increases. And once demand for product and services increases and the supply of product and services is limited, what will happen is the prices of the products and services will go ahead. So you can see how the banks, when they reduce the interest rate on the loan, there is increase in the money supply, and which leads to inflation of products and services. So this is the basic understanding how money supply can increase inflation in the market, and why RBI and central government is more focused on controlling this money supply. Now, if I want to know what basically money supply is, as per RBI, it is said that it is nothing but the total stock of money in circulation among the public at a given particular point of time is nothing but money supply. You have to understand there is difference between stock money and money supply. Let's say our country has 1,000 crores of money, which RBI
We need a vantage point to scout ahead.
only 500 crores is
No
available to the
alarms.
public in the
Do this
market.
quietly.
So the 500 crore will be nothing but the total stock of money supplied among the public. So that will be nothing but money supply in that case will be only 500 crores, but the total stock of money which you have is nothing but 1,000 crores. So I hope you have understood the difference between money supply and stock of money. Moving ahead, the circulating money involves currencies, printed notes, money in the deposit account, and other form of liquid assets. RBI regularly publishes this money supply in terms of 4 different methods, that is method 1, 2, 3, and 4. Let's say M1 is the money supply. Here, M1 is the money supply which calculates or includes currencies available in the market along with demand deposits with the commercial banks and other deposits which RBI holds. Now, what is currency here? Currency means notes plus coins.
He's in
Commercial
charge.
banks or public
Slaver.
hold. After
He's
that, what
inspecting
is
the prisoners
demand
like they're horses.
deposit?
He might lead us to Taka.
About
Follow
demand
him.
deposit, time deposit, and net time and demand liability. But here again, we'll understand what is demand deposit. So it is very easier to understand from the word itself, demand deposit. This is nothing but a kind of deposit which you do in the bank, and this deposit can be utilized under demand by customer. That is the current account or savings account which you hold in the bank, where you deposit money and you can withdraw the money at your demand. That kind of money is nothing but demand you have to give the tenure, let's say 6 months. So you withdraw the money before 6 months. So this kind of deposit is nothing but time-based deposit. So what is net demand deposit? I give you an example. Let's say there is bank one and customer has kept 100 crores of deposit in bank one. And what bank one did is it also kept its 20 crores deposit in bank. So what is the net deposit available in bank one? It will be nothing but 100 minus 20. 20 is the deposit which it has kept with other banks. So therefore the net demand deposit will be nothing but 80 crores. So I hope you have understood what is demand deposit and what is net demand deposit. What we are studying is how RBI calculates the money supply in the economy, and it has given various formulas. First is M1, that is nothing but currency available in the market or in the public, that is coins and notes. Then there is demand deposit. We have understood that what is demand deposit, and then there is OD, that is order deposit with the RBI. Remember this, it is order deposit with the RBI. This content is already available in the NCERT 12 economics, and we are taking much of the content from there. So I hope you have understood how RBI calculates money supply to this first method, that is M1. So what is M2? In M1, when you add saving deposit with post office saving of bank. So whenever you add saving deposit in M1, so what is that is M2, but saving deposit with post office saving bank. And how do you calculate M3? That is nothing but M1 again. And in that M1, you add net time deposit of commercial bank. I hope you understood time deposit and how net is calculated. Finally, what is M4? M4 is nothing but M3 plus total deposit with post office saving organization, excluding national saving certificates. So these formulas are a little difficult to remember, but if you revise them multiple times and find some relation between them, you'll be able to understand. Few important things which you should by heart in this is M1 and M2 are said to be narrow money. What is M1 and M2 said to be narrow money? M3 and M4 are said to be broad money. Another thing is M1 is the most liquid and easiest for transaction. So you have to remember two things about the money supply. Here M1, M2, M3, M4 we have understood. We have also understood M1 and M2 are said to be narrow money, M3, M4 broad money. Okay, but M1 is the most liquid one. M3 is the most commonly used measure of money supply. It is also known as aggregate monetary resource. So you have to remember two of these things. So after understanding how money supply affects inflation and how banks play an important role, so let's understand more about this bank and financial intermediaries available in our country. So there are two types of financial intermediaries. One is informal, other is formal. Informal means the intermediaries which are not controlled by any law or government or any institution. Formal means which are controlled by an institution or law. Now, if you differentiate the formal institutions, they are differentiated into banks and non-banks. So usually something like काफी बार ये difficult part लगता है, but it is very easy to understand. It is clear our concept, and most of the things you have already learned in your practical life. So I want to tell you that formal financial intermediaries are divided into banks and non-banks. हम इनके पर तो focus करेंगे. Let's start with banks. Bank को भी differentiate किया है between commercial and cooperative banks. So let's first understand what is difference between commercial and cooperative banks to a start. Now, first thing what you have to remember is cooperative banks are not made for profit purpose, whereas commercial banks are for profit purpose. Basic है, commercial bank is designed for profit, cooperative जहाँ भी use is not for profit but welfare of its members. Moving ahead, understanding the difference between commercial bank and cooperative bank. Commercial bank और public bank आती है, private आती है, foreign आती है, differential bank आती है. Cooperative में कौन सी आती है? Urban, state, central और primary agriculture credit society, अलग-अलग agriculture societies जो होते हैं, they come under cooperative bank. Now, coming to the difference again. So commercial banks for profit, they are regulated by Banking Regulation Act of 1949. It is very important to remember. Cooperative banks are regulated by Cooperative Societies Act 1965. Bank है तो Banking Regulation Act, society या cooperative bank है तो Cooperative Societies Act. Area of operation commercial bank, large area cooperative, specific purpose small area. Motive profit service. Borrower, account holder, cooperative bank member holders and others as well. Main function accept deposit from public and granting loan to individuals. The main function accepting deposit from members and public and granting loans to farmers and small businesses. Interest rate on deposit in commercial bank it is less, whereas in cooperative bank it is higher. Moving on, coming back to our differentiation. Firstly, what we understood is there are two types, informal and formal types of intermediaries. Informal intermediaries, we know there are banks and non-banks. In banks, what we know that there can be commercial bank or cooperative bank. Do you type the differentiation? Commercial, there can be public bank like SBI, private bank like ICICI, HDFC, foreign bank like Standard Chartered. Differential like
Chop Bruno.
Small finance bank. Let's understand about differential banks here. Differential bank or differentiated bank
Sorry?
is nothing but banks that are
Ante,
licensed by RBI.
Noi.
See, again is of RBI.
Noi chare.
And these are distinct from universal banks.
Huh?
Public bank, private bank, foreign bank, which work for all the purposes, whereas this differentiated bank is used only for specific purpose. For example, one of the major objectives of the differentiated bank is to promote financial inclusion and payment. Example being regional limited bank, which work only for rural areas, and the objective is to promote financial inclusion in rural areas. Whereas small finance bank work for small industries or small households. So this is another niche area where this differentiated bank works. These differentiated banks, they are differentiated by the objective or purpose. So you have to remember. And this is also nothing but commercial bank. That means the motto is here again. earning profit. Differentiated bank in India in 2014, Nachiket Noor committee, the idea of this differentiated bank came from this, and based on the recommendation, differentiated bank approach was introduced by RBI in 2014. So I hope you have understood what is differentiated bank and how commercial bank and cooperative bank are different, and why this public, private, and foreign banks are also called as universal banks. So after understanding banks, let's understand what is the basic difference between banks and non-banks. Banks are basically those financial institutions which are regulated by Banking Regulation Act, and RBI has control over this bank. Whereas non-banks are created for different kind of purposes, like all India financial institutions are created for regulation, whereas NBFCs are created for other purposes which bank cannot satisfy. And the control of this non-banking financial institution is done by different organizations. So let's start with the AIFI. AIFI is nothing but All India Financial Institution, and right now we have 5 such financial institutions, starting with Exim Bank, NABARD. We have regularly heard about NABARD. It is non-bank, and we cannot open a bank account there. So you are getting to understand difference between bank and non-bank. So NABARD we have heard, that is nothing but National Bank for Agriculture and Rural Development. Other is SIDBI, that is Small Industries Development Bank of India. NHB is National Housing Bank. And latest we have added as AIFI is National Bank for Financing Infrastructure and Development. So all these non-banks here under AIFI are created for promotion, growth and development of particular industries like export-import, rural agriculture, small industries, financing infrastructure and development. So I hope you have understood this kind of non-bank. So another type of non-bank we need to study is about primary dealers. So these dealers buy securities directly from the government, and they can resell these government securities to other members later. So these kind of institutions are also non-bank institutions, and they have given a special authority to buy government securities and then resell those securities in secondary market. So this is also kind of non-bank. Now moving to third kind of non-bank, which is very important, is nothing but NBFC. Most of the time we have heard about NBFC to be non-banking financial corporation, but let's understand what the NBFC exactly does. So NBFC is non-banking financial institution that offers financial services and products, but it is not officially recognized as bank with a banking license. Therefore, it is said to be non-bank. What is the difference between NBFC and a regular bank? NBFCs can't accept demand deposit. So you have to remember this important fact that NBFC can't accept demand deposit. Demand deposit means they cannot open current account or saving account. They also don't form part of the payment and settlement system. Also, they can't issue checks drawn on themselves. You have to remember about this difference between a bank and a non-bank financial corporation or institution. They can't accept demand deposit, and they can issue their checks, or they are not involved in payment and settlement system. So deposit here can be two types: time deposit, demand deposit. Time deposit, fixed time, that is example FD. Demand deposit, saving and current account. And we also know about total demand liability, that is time liability and demand liability. And NTDL, that is net time and demand liability, is nothing but all the liabilities minus the liabilities which we have kept with other banks. So I hope we have already discussed and revised here again. So bank's NDTL is very much important concept, and its reference will come ahead in the lecture as well. So we have understood that NDTL is nothing but demand and time liabilities or deposit minus deposits with other banks. So this is nothing but NDTL. Now, for information, I have also added the criteria which are necessary to start an NBFC or NBFI. The company should be registered under Companies Act. Secondly, the corporation must be either private limited or limited, public limited company, and the company must at least have 2 crores of net owned fund. So if you have satisfied all these conditions, then you can form an NBFC. What is the importance of NBFC in India? See, in country like India, where access to banking finances remains a challenge, NBFC plays a crucial role. They charge you higher interest, but they give you services which a normal bank fails to provide. Also, non-banking financial institutions are type of institution that offer services to the market segment that commercial banks don't offer. And why they don't offer? Because there is high risk and low return. So in this situation, NBFC plays an important role. Another thing, NBFCs are essential part of the economy's financial sector because of their inherent characteristics. So this is the reason why NBFC is important, and how NBFC is different from bank, and how we have studied all these types of non-banking financial institutions. The banking financial institutions are regulated by RBI, and these non-banking financial institutions have different regulators. For example, in NBFC like LIC and insurance are regulated by insurance department. Now let's focus on the RBI and understand its function and how it plays an important role to connect with the banks and control the money supply in the system, and ultimately controlling the inflation and growth of our country. Some of the important events related to RBI which we should remember: in 1934, Reserve Bank of India Act was enacted, and after this act, in 1935, Reserve Bank of India was established, and you have to remember it was earlier headquartered at Calcutta, but in 1937, it was permanently moved to Mumbai. Now it is in Mumbai itself. And in 1949, RBI got nationalized. Before it was held by private stakeholders, but after 1949, the RBI was totally nationalized, and the shares were owned by government 100%. So this was a brief history about RBI. This is the emblem of RBI consisting of tiger and a palm tree. So you have to remember this. Moving ahead, let's understand the basic and important functions which RBI plays and why it is said to be the most important and central bank of our country. Firstly, the most important function it plays is monetary authority. We'll study in details in next slide how RBI helps in implementing and monitoring the monetary policy of our country. Another important function of RBI is act as a regulator and supervisor of the financial system. RBI is an institution which maintains public confidence in the system, and also it protects depositors' interest. So whenever we hear that a bank cannot be collapsed because RBI has already made sure through its regulation and supervision function that the interest of depositor is not hampered. Another important function of RBI is it is a manager of foreign exchange. You have regularly heard that RBI has foreign reserves, and these foreign reserves are continuously used to monitor and control the foreign exchange in the market, which indirectly and directly helps in the promotion of export and import activities of our country. So another important function of the RBI is it is issuer of currency, and we have seen RBI has been given power to issue this currency, and therefore on the paper money we see the promise made by RBI governor. So this is another important function of RBI. Another function about RBI is it supervises payments and settlement systems, and it also has a related function to be banker of the government, also banker to other banks, also called as lender of last resort. Because whenever any bank requires some funds in emergency, it can always go to RBI because it is said to be banker's bank. And also government is dependent on RBI as a banker to the government. So I hope you have understood the functions of RBI, that is monetary policy control, then regulation and supervision on the financial system, foreign exchange reserve management, issuer of the currency, also banker's bank. So these are the important functions of RBI. Moving ahead to the last part of our lecture, that is about understanding about the monetary authority function of the RBI and what does monetary policy mean and how it has come into effect today. So firstly, we have to understand that how RBI and government are working together to discuss or to control inflation and growth of our country. So RBI and government came into an agreement known as Monetary Policy Framework Agreement around 2015. So this agreement was signed between the RBI and central government, setting quantifiable targets for the monetary policy. So monetary policy is nothing but a policy which defines about the targets of inflation and the growth of our economy that we have to achieve in future. So these targets are jointly set by RBI and central government, and this was done under the Monetary Policy Framework Agreement. So the Reserve Bank of India and Government of India signed this agreement in 2015. This was a proposal led by RBI Deputy Governor Ujit Patel Committee, and therefore this Monetary Policy Framework Agreement was brought into effect. The primary goal of this monetary framework is to maintain price stability and also to pursue growth. So you have to remember how RBI and central bank are working together to this framework agreement brought into effect because of the Ujit Patel recommendation. So understanding of this agreement, what is how it is executed at the ground level and how monetary policy committee is framed and how it works function. So origin of this monetary policy committee is it was done after amendment in 2016 in the RBI under section 45 JRD. The objective of this committee was to determine the policy rate required to achieve the inflation target. So these targets were set under this monetary policy framework agreement, but the execution was done by the monetary policy committee. So objective was to achieve the inflation target, that is stability and overall growth of the economy. The decision of this MPC committee shall be binding on all the banks. Now let's discuss the composition of our MPC committee. It consists of 6 members, 3 from RBI and 3 from central government. RBI governor acts as an ex officio chairman of this committee. Deputy governor, in charge of monetary policy, is also a member of MPC. An officer of the bank to be nominated by the central board of RBI. So these are 3 members from RBI, and other 3 persons are to be appointed by central government. How are they appointed? The government nominees to the MPC will be selected by search from selection committee under the cabinet secretary with the RBI governor and Sunami Patel secretary. And how the decisions are made by this committee? Decisions will be taken by majority vote, with each member having a single vote. And the RBI governor will chair this committee. So there is no veto power to the RBI governor here. Each member has 6 votes, and whenever there is tie on casting of vote on a particular matter, in that situation, the vote of RBI governor will matter. Now, what we have understood is the role of RBI and central government is to control inflation and also to monitor the growth. And to do so, it has to control the money supply through the banking sector. We have understood how the financial intermediaries are divided into banks and non-banks. And we also understood that banks are divided into cooperative banks and commercial banks. And also NBFC and other institutions have been studied in detail. After that, we understood what is monetary policy framework agreement that has been done between RBI and central government, where they set the parameters for inflation and growth. And to execute those parameters, they have also formed a monetary policy committee consisting of 6 members, and the chairperson is RBI governor. Now, this committee has few tools that they implement on the bank so that they control money supply in the market and effectively the inflation. So these tools are divided on the basis of qualitative methods and quantitative methods. In the next lecture, we'll discuss in detail about all these tools like bank rate, open market operation, what is cash reserve ratio, what is statutory liquidity ratio, what is LM, what is marginal standing capability, why these are called quantitative tools and why tools like fixed margin requirement or credit rating or moral suasion are called into qualitative tools. So these tools will help RBI and the MPC committee to control the inflation. So I hope you have understood the banking and finance section here, where we have tried to give logical steps by focusing on things you already knew and then connecting the dots. So in this way, we have completed the initial first part of banking and finance, where we have understood what is the role of RBI and how RBI uses different tools like quantitative and qualitative tools to control inflation and money supply in the economy. In the next lecture, we'll discuss in detail about all these tools and how questions are framed in the UPSC related to inflation and money supply. Thank you. Hello and welcome to the second session of our topic banking and finance. Uh, banking and finance. In this lecture, we have covered the topic of economy and GDP. We have also seen that GDP is measured and compared with respect to other parameters. We saw the inflation and GDP are the macroeconomic factors which we are focusing in our study of economics for the exam of UPSC. So the topic of banking and finance is very much important and related to the inflation and GDP or growth of our country. So we started with the first lecture of banking and finance. Where I'll try to give you a brief overview of what we learned in our previous lecture. So we started with the overview of topic. We tried to understand how banking and finance is affecting the inflation and growth of our country and how RBI is an important institution playing a role in the banking and finance system to control the inflation and growth rate of our country. After that, we also tried to understand what are the different types of institutions playing a role in banking and finance sector. And lastly, we tried to understand how inflation and money supply are related with each other. So we started with the common link between banking and finance and business. In money, we tried to understand what is the main function of money for its introduction or
I
discovery.
wish you had gotten
Firstly,
here
we
before they
understood
burned
that
half the
money
town.
is used as unit of account. So what does unit of account mean? So if you want to compare mango and an apple, you will compare it with the unit of money that is in terms of rupees. So let's say a mango can be said to be of 50 rupees and
Things
an
will
apple
be
can be said
fine.
to be of 10 rupees. So this
They
15
have to
and 10
be.
is nothing but unit of account. So that is the first function of money. Second, what we saw is it is store of value. That means what? If you have a currency note of 100 rupees, so that means this currency note has store of value of 100 units. So I hope you have understood the second function of the store of value. Third function what we saw is it is medium of exchange. So whenever you want to purchase or sell anything, money can be used as medium of exchange. So after understanding the function, we went into the history of money and how it has evolved from barter system to today's digital currency and cryptocurrency. So first we started with the barter system and we understood it has limitations that the coincidence of one of two individuals must match and only then this system can work. After understanding the flaws of barter system, we went to commodity money and where we tried to give value to some of the commodity in terms of money. So here, what we tried to do is we took paper bills ourselves as a form of money and use it as medium of exchange. But it also has few of the drawbacks, like it was perishable and not fungible or divisible. We moved on to token money and full body money. So full body money, the example was gold coin. Token money is nothing but the coin which we use today. And we saw there was a difference between token money and full body money. The main difference was it was about the intrinsic value. Intrinsic value of the full body money. Your gold coin was more than compared to the token money. That is the face value of that money. So intrinsic value जब भी ज़्यादा रहता है compared to face value, it is nothing but full body money, that is gold coin. Token money means the metallic coins which we use today. So we also understood the difference between token coin and full body coin. After that, we moved on to understand what is fiat money and legal tender. Fiat money means any money which is issued by some competent authority, and legal tender gives this basis that it cannot be denied. We also understood the difference between fiat money and legal tender through an example of rupees 500 and 1000 notes which were demonetized in November 2016. So after November 2016, these notes were not considered to be legal tender even though they were fiat money. So after that, we understood what is the difference between digital currency and physical currency and also how cryptocurrency and blockchain technology is working today. We also understood that digital currency is that currency which only has its existence in digital form. Today, India has launched its own digital currency that is e-rupee, R-U-P-E. After that, we also took a current affair topic of e-rupee. This is nothing but a voucher created by NCCI. After that, we understood about NCCI and how it has played an important role in our banking and financial system through the introduction of UPI and everything. We also understood this e-rupee is nothing but a voucher which can be used by a person for a specific case and which is very much important in the public distribution.